Hey all, Aubrey here. So I wanted to talk about 401k and taxes and really make sure that you're clear about the tax advantages of a 401k. I've seen a few articles now about maybe 401ks are not a good idea because the tax savings maybe is not as good as you might think. And in a worst case, you don't contribute to a 401k because you are concerned about this tax issue, but really it's misinformation, and that you find out later when it's too late that you've missed out on thousands of dollars in tax savings. So before we dive right into 401k and taxes, first I think it's important to understand kind of how the tax brackets work and how your salary is being taxed throughout the year. So the way the taxes work in the US is it's a tax bracket system. So it's a series of brackets starting out with low tax, going up to higher tax, and the tax is based on how much income you make. So the lowest tax bracket is 10%, and it goes up to 37%. So for this discussion, we'll just be talking about the first three tax brackets. That's the 10%, 12%, and 22%. You could visualize it this way. You have a bucket, and you're going to pour in 3 gallons of, say, money. The first gallon of money that you pour in will be taxed at the 10% rate. The second gallon will be taxed at the 12% rate, and the last gallon you pour in at the 22% tax rate. Now, a common misconception is that when someone says, hey, I'm in the 22% tax bracket, that their entire income is taxed at 22%. That's not the case. 22% is just the highest tax bracket that they're in. They are also in the 10% tax bracket and the 12% tax bracket, but usually we refer to the highest tax bracket that we're in. That's just commonly what's done. With an $80,000 salary, they're actually only going to pay about 13.3% taxes. It's about $10,600. They're going to pay 10% on the amount of money that falls in the 10% tax bracket. They'll pay 12% on the money that falls in the 12% tax bracket, and then 22% on the part that falls in the 22% tax bracket in our imaginary bucket. And so averaging those together, calculating that total, comes out to 13.3%, or $10,600 roughly. And that's the tax that they pay on that $80,000. Now, the great thing about taxes is that any deductions that you take are going to come out of that 22% tax bracket, the highest one. This also includes contributing to a 401k. If we're saying someone makes $80,000, that salary falls in the 22% tax bracket. Now again, it doesn't mean that their entire $80,000 salary is going to be taxed at 22%. 22% is the highest tax that they are in. So say this person contributes $10,000 to a 401k. It gets deducted from their income, and it comes out of the 22% tax bracket. So that $10,000 would have been taxed at 22%, but they have set it aside into a 401k, no taxes paid on it. But it would have been taxed at 22%. That's important, so we'll remember that. Now, in the future, we fast forward 20 years, 30 years, 40 years. Now we're retired, it's time to withdraw from the 401k, and we want to draw a similar salary. We'll say $80,000. It's taxed as income, which means a portion of it will be taxed at 10%, a portion at 12%, and a portion at 22%. Same thing if we imagine our bucket like we had before, same thing. And again, the average tax is going to be 13.3% on that entire amount. Now, there's a comparison to be made. We originally took the $10,000 from the salary and we escaped paying 22% tax on that. Later, when we take it out, we're paying an average of 13.3%, not 22%. So we've saved almost 9% in taxes. It's about $7,200. That is a lot of taxes. Now, even if taxes go up, they would have to go up quite a bit to make it so that it's not worthwhile to contribute to the 401k for the tax savings. So just to take this one step further, say taxes do go up, and most likely one scenario is taxes will kind of return to the levels they were back in 2015, 2016. taxes were just higher across most all the tax brackets. If we run the same scenario, an $80,000 income, and we look at what the taxes would be on that $80,000, it's going to come out to about almost 18% tax instead of our 13.3. And the taxes are going to go from $10,600 to about $14,000. However, we're still comparing the 22% tax that would have been paid on that money that we put into the 401k, 22% tax, compare that with 17.75% tax, and you're still coming out ahead. One more thing to consider, estate taxes. The state tax is assessed on any income you receive while you live in that state. So if you're contributing to a 401k, you not only defer or escape from the federal taxes, but you also defer the state taxes. Say you retire in a state that doesn't have income tax, and there are actually 9 states that do not have income tax. Florida, Texas, Nevada, Wyoming. Florida is a very popular state for retirees, and one of the reasons is there is no state income tax. So the income tax that you would have paid in, say, a state like Virginia, where the income tax is 5%, you move to Florida for retirement, and now when you withdraw from your 401k, you don't pay any state tax. And that's another savings that you get, but you only get that if you've contributed to a 401k. I'll post some links in the description below of some things I think will be helpful if you'd like to look into this further. So if this content was helpful for you, I invite you to subscribe, hit the like button, and we'll see you on the next video.